up, guys? Welcome back to my channel. I hope you're doing good because I'm doing pretty good. So if I'm doing pretty good, you gotta do pretty good. I hope you're doing good. While you were scrolling through YouTube and going and trying to find a good video to watch, you stumbled on my channel. Thank you very much. Here we talk about everything that has to do with money, everything that has to do with personal finance, everything that has to do with investments, everything that has to do with stocks, everything that has to do with money, dollar signs, everything that has to do with dollar signs, we talk about it on this channel. So if you like that, subscribe. If you don't, subscribe. Topic today is going to be a stock analysis video, but you might ask me, what stock are we actually talking about today? We're talking about a stock that has completely revolutionized movie watching forever. We're talking about a stock that has completely put all blockbuster locations bankrupt. We are talking about a stock that exposes the really super rich weirdos in this world to being pedophiles. Too soon? We're talking about Netflix stock. Let's get into it. This is my favorite mug, if anybody wanted to know. Nobody really wanted to know, but I want to let you guys know. Sorry, not sorry. Anyways, let's start with their income statement, which tells us how their sales have been and how profitable they've been with their sales. Let's get on my computer. All right, so let's look at their annual revenue numbers. So from 2016 to 2020, their annual revenue have increased aggressively. So what I mean is in 2016, they made $8 billion in sales, $11 billion in sales. In 2018, 15, 2019, 20 billion, and then recently $22 billion. So a big reason for this was that Netflix was receiving much more new subscribers because they were the only players, if not the only big player in the movie video streaming service business. Back then, there wasn't Hulu, there wasn't Disney, there wasn't Amazon Prime. It was really Netflix and other smaller competitors, but they had the bigger market share. All right, so let's look at their profit numbers. So from 2016 to 2020, their profit numbers have actually went up. So 2016 to 2 billion, and then 17 to 4 billion, 2018 5 billion, 2019 7 billion, and to date $8 billion. Their net income has also increased every year, which is a pretty good sign. It's right here. So 186 million in 2016, $558 million in 2017, 1 billion in 2018, 1.8 billion in 2019, and 2.681 in recently. Which is very impressive. However, if you look at why they go from a $22 billion revenue year to a merely $2.681477 billion net income, you have to ask yourself, where is the $20 billion going? Well, the reality in this company, the reality of their costs is for them to actually get $22 billion in revenue, they have to spend $13 billion, almost $14 billion, which is kind of scary. And this doesn't include other costs. It doesn't include their costs of research and development, which is almost $2 billion. So you have to ask yourself, yes, they're making $22 billion, but why are they only netting $2 billion? It makes no sense. So let's continue and see what's next for this company. Okay, so let's look into their balance sheet right here. And this will really give us an idea about the health of the company, and in other words, how financially strong they are at the moment. All right, so let's look at their current assets and how strong they are in that category. We can see here that their current assets is actually $6.178 billion, which honestly from the naked eye seems great. But trust me, there's issues coming up. All right, so let's look at their current liabilities. Their current liabilities is their expenses that they have to pay in the short term, so a company has to have enough money to pay their short-term liabilities, and the way they do so is by using their current assets to pay off these expenses. What that basically means is their current assets must be higher than their current liabilities, because then we can say, okay, they have the financial capabilities to pay off their current expenses, which is their current liabilities. So if we go on the balance sheet and we see that Netflix, the total current liability of where is it here? It's right here, guys. $6.855 billion, which, if we look at it, is actually more than what they have as current assets. So they have more current liabilities than their current assets. So that basically tells us they can't really pay their bills, their expenses that are coming up right now if they all came up at once. So it's not really a good sign, as their current liabilities, which is short-term expenses, is about $700 million more than the current assets, which is the finances they have on hand at the moment to actually pay their bills. So yeah, that's pretty scary. Let's keep looking through it, as this is not really a do or die scenario for Netflix, but it kind of gives us a red flag. So sorry I'm being a bit repetitive, guys, but I just want to make sure that the saying, don't judge a book by its cover, is understood. I mean, yes, we saw a red flag with the current assets. However, if you look at just that statistic, you will say, okay, Netflix is not a good investment. But if you look at other statistics that are important, as you have to understand a company as a whole, like total assets and total liabilities, you'd understand that maybe the current assets is not a big deal. Total assets that they have is $33 billion, almost $34 billion. And if you compare that to their total liabilities, which is $26 billion, you can see that if ever they couldn't pay their current liabilities or their current assets, they can always sell some of their plants, their properties, their long-term assets to make ends meet. So just make sure that when you're investing in a company, you're looking at the whole company as a whole and not just one statistic. Okay, let's continue with the analysis. So I wanted to bring up another aspect of this company, which is their annual shares outstanding. And the reason why I want to bring this up is because with a company that has a high cost for revenue, I really want to see how they're actually paying for a lot of things, and if they're actually in need of money every year. And so what shares outstanding is basically how much Netflix is issuing shares into the market every year. So that means that because Netflix needs money or is in need of money, they are actually issuing new shares into the market for new investors to buy, which is in return diluting their current shareholders or their original shareholders. But what this does for Netflix is they actually get more money to invest back into the company. So if you're an original stakeholder, this is kind of a red flag for you, or a future stakeholder. It is a red flag for everybody, to be honest with you, because if they're issuing shares every single year, you're getting diluted every single year, so your shares are actually worth less than when you actually bought them. So let's see, from 2015, they had 436 million shares outstanding. Then they increased that by 3 million to 439, and then 447, and then 451 in 2018, and then 452 in 2019. Just last year, they increased the amount of shares available by 1 million. This is not really a good sign for shareholders because it shows a projection of their shares getting completely diluted in the future. And it shows that, obviously, we know that Netflix does not, that it has a high cost of revenue, but it shows us that maybe their cash flow from operations is not enough. Which brings me to the cash flow for Netflix. And yep, I was right. Netflix actually does not generate any cash flow from operations, which explains why they keep issuing new shares to the market. I mean, let's look at it, okay? Like we said, from 2015, they kept issuing more and more shares, right? So if we go here and see their cash flow from operating, since 2016, they were never actually netting any positive cash flow at all from operating. If we go down to the actual free cash flow, which is right here, we see that it's negative $1 billion plus. We can see that this company is still, to this day, not profitable, regardless of what their income statement states about their net profits. They invest so much money back into the business, like making Netflix original shows, and paying for content and R&D, that they are still not profitable, which is why, again, they keep issuing new shares. This, to me, is a pretty big red flag, and I think it should be considered when we're considering if we should invest in this company or not. Now that we analyze the financials, let's look at their competition and how that's affecting them in the market. So yes, there are a lot of other companies that are considered competition for Netflix, like Amazon Prime, HBO, Hulu, just to name a few. Hulu, just to name a few. However, there was a survey that came out about 2 or 3 days ago, I believe, that asked a bunch of people, what streaming service would you keep post the global pandemic? So when the global pandemic passes, what streaming service would you keep? And 41% of the sample size said Netflix over all the other services, which is a great sign because it shows that people see Netflix as the dominant streaming service in the actual market. In the same survey, the 41% of people who said Netflix is the current best choice were asked if the service had went up in price by $2.20 a month, would you stay subscribed? And all 41% said yes, which is great to hear again, because since we know that Netflix keeps issuing shares, maybe the increase in price can give them more cash flow to invest in R&D or whatever they have to do to keep the business running and to keep the business more innovative in the future. Basically, what this means is that a lot of people see the value in Netflix compared to all other competitors, which is really awesome to hear. So, my final thoughts on Netflix. I do not believe, with everything that I had just explained and the financials and everything on paper, I do not believe that Netflix is worth 500 plus a share. However, I do think that for this company, you have to use intrinsic value, so your subjective perceived value of this company. So I'm going to be looking at what I think this company is going to do in the future, and is it going to be a bright future or a negative future? And what I base myself on are the following. I do think that Netflix provides way more value for the client than any other streaming service, so that assures the dominance of Netflix on the competitors. 2, I do know that they can increase the price by $2+ and people will still pay, and those 2 first points were revealed in the survey. And 3, and I think this is the biggest one, I truly believe that the future of streaming is going to be completely different than what it is right now. And what I mean is, I think Netflix is going to swerve more towards the side of production. I think they're going to be producing a lot more movies than buying the licenses for movies that are already made and selling them on their platform. I think they will be producing way more movies to make their stuff exclusive on their platform, which will force people to have to subscribe to Netflix to actually have access to their content that, in my opinion, is very valuable. They've made a lot of awesome Netflix original shows and TVs. 1, Outer Banks. 2, Don't Fuck With Cats. 3, Jeffrey Epstein's documentary. I mean, that's just naming a few. They have a lot more Netflix originals that did really, really well. And I think that's really the prime point, which allows me to believe that Netflix stock should be around 450, 500 plus as a fair value for the company. Alright guys, so we've reached the end of the video. I really appreciate you watching this video. Thank you so much. If you thought this information was in any way helpful, or you learned something, or you were looking for Netflix and you found a video that actually taught you something about Netflix, I would really appreciate a subscribe and maybe a like or a comment. It really encourages me to make a lot more videos for you guys just like this. Thank you for watching. See you in the next video.